Good morning, everybody. Welcome back to another Market Open. It is October 11th, 2023. It is 8:46 a.m., and we have an exciting show to get to because we got a lot of data that even, quite frankly, I forgot until this morning we were getting this data, and I woke up and I was like, oh, we're getting this data. This is going to be a pretty big day in terms of how the markets are going to analyze it. What do we have? PPI data. That's the first thing we got to talk about. PPI data came in a little bit hotter than expected, so we're going to talk about the actual specifics of the numbers. The market seems to be shrugging it off. The market was actually doing very well in the pre-markets, went down just a little bit when the data came in hotter than expected, but still recovering. So still green in the pre-markets. PPI seeming to not have that big of an effect on the overall market, and it may just be because the market is tired of seeing headlines that decides that it needs to sell off. Second of all, we got Exxon Mobil officially agreeing to buy Pioneer Natural Resources for nearly $60 billion in an all-stock merger. So we've got some updates on why that's happening, how that's going to be happening, and ultimately what that means for Exxon Mobil stock. And then on top of that, we've got something pretty interesting. This was the most, unique piece of news that when I woke up, I saw. The 10-year yield is at 4.5%. I mean, we haven't seen 4.5 in a while, and that's a pretty nice decline from 4.9 just 2 weeks ago or just last week. So seeing that 10-year come down pretty aggressively, that may be signaling that equities have capitulated, found their bottom around that 420, 425 range, and money is flowing out of, or money is flowing into equities because yields, as they're going down, simply means that people want to get a more risky return versus a risk-free return. So we got a lot to talk about, a lot to see what's going to go on. Obviously, PPI data dominates this, and we'll keep going from there. Victor Hernandez, Greg, Casper, Zach, David, Raul, Jaime from Romania. That's awesome, man. Thank you so much for joining. Sethi Roth, good evening from Singapore. Power Napster, Joseph Viegas, Inbound, Warren Puffett, Mark LeBlanc, Myra Singh, Peter. What's up, Peter? Erwin, good morning from Boulder, Colorado. Broccoli Bob, June, Raul, Juan Carlos, Peter. Again, thank you for the $5 super chat. The big homie Amit, I appreciate it, man. It means the absolute world to me. Thank you for that super chat. Mohit, Jeff, Gloria Beads, Midwest, Jeremy, Honest Chill, Art of War, ER was right, Christian B. All right, let's get into what we've got going on. So first thing we're going to discuss is PPI. Obviously, that is the biggest news. The 2-year is underneath 5%. I think the 2-year, let me check it right now. The 2-year is at 4.9 or something. 2-year bond yield. It is down from being above 5%, which is the important thing. Oh, it's right at 5. Okay, so when I was looking at it this morning, it was 4.9 something, but it's 5.001. So we're at 5%, but obviously it's very volatile because it was going right down below that, which is a good thing, right? We're not seeing it at 5.1, 5.05. We're seeing it actually tick downward, which is the momentum we need to see as some of this data comes out, and we have equities potentially having a chance to do well. So let's get into PPI. All right, so here's the PPI data that we have, and then we're going to get a lot of analysis on if this is good, if this is bad, because quite frankly, the markets don't really care about this PPI data as aggressively as I thought they would. All right, here is PPI. So year over year in September, the actual was 2.2 versus 1.6 expected. Now, not only did we expect 1.6, last month in August, we got 1.6. So this is actually quite materially above the not only expectation, but the actual read that we got in August. So that's a little bit hotter. PPI month over month, 0.5 versus 0.3. That's a 0.2% increase. Remember, folks, the CPI is tomorrow. I'll be live at 8:20 a.m. Central or Eastern because CPI will be tomorrow at 8:30. We'll get those numbers. That one is a lot more of a headline defining number in terms of the stock market. But PPI came in hotter, so you would imagine that CPI comes in a little bit hotter. Now, previous was 0.7, so it did decline. Notice this. This is why I think the market's having a nuanced time trying to understand these results. PPI is hotter than what was expected, 0.3 versus 0.5, but it's lower than where we were in August. Now, if we were not lower than we were in August, I think that's where you would see a little bit more market volatility to the downside, but we are seeing some upwards momentum because the PPI actually came in better. Core PPI year over year September, actual 2.7 versus 2.3. Our previous was 2.2. So we expected a tick up from 2.2 to 2.3, but it went to 2.7. So a little bit more of aggressive of a tick up. And then core PPI month over month in September, actual is 0.3 versus 0.2. We had 0.2 in August. We expected 0.2. It ticked up 0.1. So month over month, we ticked up 0.1. Year over year, we ticked up 0.5. Month over month, in terms of not core, we went down 0.2. And year over year, not core, we went up 0.5. So on 3 of the 4 metrics, we missed. On 1 of them, we beat, which is why I think the market's a bit confused right now on like, all right, is inflation actually declining or is it not declining? What's going on with inflation? Where is it coming from? Are we going up? Are we going down? How is inflation actually acting right now? So again, if you're just joining, core CPI, core PPI on both metrics missed, meaning we came in hotter than expected month over month and year over year. However, month over month on regular PPI, we came in 0.2% lower than expected, which might actually be saving the market right now. Right now, if we take a look at the market, S&P 500 at 435.70. It was at 436 just a couple of minutes ago. So 435.70, not bad at all. Remember, the S&P 500 was at 419 last Thursday. We were pretty much below that 200-day moving average, and now we're at 435. Robinhood, a big winner in the pre-market. It was at 1014 at one point. Right now, 1008. SoFi, 842. TFC, Truist, 2950, continuing its run from yesterday. Palantir, 1789, up 0.51%. So we're seeing some upside momentum in stocks as we got this PPI data. For those that don't know what the PPI is, it's essentially the producer price index. So it is the amount producers pay in order to have a certain set of goods in their supply chains, in their ecosystem, right? If you're selling a hamburger, you have to pay for the bread, you have to pay for the meat, all that stuff. So the CPI is how much consumers have to pay for that stuff. If the PPI tends to be a little bit hotter, the CPI might end up being a little hotter, because if producers are paying more for their stuff, consumers may have to pay more to buy those things. However, on the month over month metric, PPI came down, even though on some of the year over year and core metrics, it went up. Let's get some analysis on this, on the bull case as well, for why this is actually not that bad and why PPI is probably not going to affect the market in terms of that big of a effect.
And Steve, why don't we start with you? Other things you want to pull out from this data we just got?
Yeah, I guess I'll start just disagreeing a bit with Rick. I mean, I think that if you look at how the market has reacted to upside economic surprises, there is definitely a piece of this surge in yields that has to do with better economic data. It moved pretty sharply through the months of July and September and August as we were marking up GDP, but also as the government was issuing and surprising the market with issuing debt. So there's 3 parts to the rise in yields, and I think all of them have a place in the discussion. Stronger economic growth, greater issuance by the Treasury, as well as more hawkish Fed talk. When I look at this number today, Becky, I see a big piece of energy in there and a big piece of trade services. So I'm not quite sure I'm going to get too excited about upside on the services side or the PPI side of inflation here. And when I look at how the Fed funds market has reacted, which is almost not at all, and in fact, through this whole process of stronger economic growth and higher yields, what we've seen is there is not a higher inflation component to it. As every Fed speaker and almost every Wall Street analyst has noted, these are rises in real yields. These are not rises in inflation expectations.
All right, Joe, you get to decide who's right.
I'm going to have to go with Steve. No, I'm going to have to go with Steve. Although I would add, one of the factors that's pushed yields higher, we've modeled this, is actually Asian-related selling.
As you can see, that 2-year at the time they recorded this, it was at 4.984. Right now it's 5. But the 2-year coming down, 10-year coming down at 4.5. That is really good for stocks. And if they keep declining in the face of data that isn't the best, I mean, if we got this report 3 months ago, the market would be tanking because we just weren't in an economic environment where we could afford to get this type of data. But right now, the market seems to be a bit more resilient.
So if you look at what we think is coming out of China and Japan, both investor base and official authorities, we think there's a lot of selling so as to prevent those currencies from weakening further, which means that if the BOJ eventually sort of comes off this yield curve control and they come off of negative rates, actually that could be beneficial for treasuries as it stabilizes the dollar and stabilizes their selling. But Steve is correct. It's really been about real yields, or what the Fed calls term premium. That will hurt the economy. If you look at mortgage spreads, the Treasury mortgage basis is very wide. Mortgage rates are 7.5%, 8%. That will weaken housing. Manufacturing's in recession. So as I've said many times, Fed's overdone it. The question is, when does the economy roll over?
And what do you think the answer is to that?
If you look at the yield curve, Becky, it says that we could go as late as Q1 of next year in terms of like the longest time we've had to wait for something to happen. It would have happened back in the spring, but the Fed added $400 billion in liquidity through its balance sheet and the bank term funding program. But the economy, I would argue, again, the underlying structure, the foundation of the economy is soft. And the fact even the 10-year yield's at 4.50, that's still high. And the fact that bill rates are at 5.50 or thereabouts means your equity risk premium is deeply negative. And the equity market has not made a new high in some time.
Yeah. Hey, Betsy,
that's bullish, right? Because if your equity risk premium is negative, meaning that there's actually less of a chance to take a risk into the equity markets versus into getting a real return in terms of that bond yield, and the equity markets haven't made a new high since July 31st, we're at 436. The high was 460 this year, and 445 is where the market, from a technical perspective, sees a lot of resistance. This PPI report, as bad as it is, you could argue it's pretty bad. It's not bad enough for the market to feel that they need to sell off again after just having a 10% correction. Let's get a little bit more coverage on this, and then we'll move on.
Let's just talk about how the economy looks to you, because you've got inflation because consumers continue to spend. We had Bank of America on earlier this morning talking about how they saw card spending up by 0.7% for the last month. It doesn't look like a lot of weakness to date, but do you worry about what's to come? Do you think the Fed's done too much?
We definitely are seeing robust or resilient consumer spending. And the Fed has been working in an environment where consumers keep spending now for the last 2 years. But there is concern, or maybe you would say hope, depending on how you look at it, that consumer spending is going to start to soften. I think it's going to start to soften because of the kinds of headwinds that consumers are facing. They've run down a lot of the savings that for a long time they had excess savings in their balance sheets. They've run that down. We've got student loan repayments that are restarting. You have this increase in housing prices that really hurts budgets. And then we've got the expiration of the funding for childcare, which is going to either push childcare costs up for some families and lead other families to decide they can get by on one income.
So she's talking a little bit more about the struggling problems of the consumer. They go on in that clip to say that, if I had $1 for every time I was hearing that the consumer was going to be in trouble, I would have more money than the entire Federal Reserve, right? And for the past couple of months, we have heard the consumer is in trouble. I think, look, it may be a little bit too early to say the consumer is not in trouble and that the consumer will get through it, primarily because student loans haven't officially started. Like my first payment for student loans, I have $10,250 in loans. Starts on October 26th. So I think near the end of October, that's when people really are going to start to, have to take some money out of the economy, or at least we're going to start to see those outflows. SoFi's earnings will give us a good understanding of how much student loans originations are happening. But Q3 earnings, I think, are going to be good. I don't think the consumer was struggling that much in the summer. I mean, people were going on trips, vacations. Pepsi earnings came out yesterday, was fine. Nike earnings were phenomenal. Like, those consumer staple stocks have been fine. It doesn't seem like the consumer is in that much trouble. The stock market continues to act as if the consumer is not in trouble. The question becomes going into 2024. So this is what I want to talk about here. Rates going down is really good for the equity markets to go up. But remember that when rates go down, that also means that when yields go down on bonds, that's good for the equities going up. But when yields come down, that also means that something might be happening, especially if rates start coming down, right? Like the Fed's not going to just lower rates because, they just want to lower rates. They're likely going to lower rates because there's going to be some problem, something that's breaking in the economy. And I think the existential question, all of us as investors, and it's not just, retail investors like you and me, it's the biggest investment institutions in the world, the biggest hedge funds. They're trying to figure out, is there a world in which the Fed can lower rates without something breaking as the justification, the validation for them to lower those rates, meaning there truly is just a soft landing. So for example, the chances, this data came out last night, for interest rates to be raised in the November meeting went from 30% to 11%. That means in the November FOMC meeting, or I think it's on Halloween, October 31st, the chances of the Fed raising rates again, another quarter, another half a basis point, is 11%. It was at 90% 3 months ago. It became 45% 2 months ago. It went to 30% 2 weeks ago, and now it's at 11%. Well, why yesterday did it come in at 11%? Well, Juan Carlos was like, finally, you're talking about this. Yeah, I was thinking about this for the past couple of days. I was like, all right, we got to have a discussion on this because this is important. We got, as bullish as we all are, we do have to discuss, what could be the downside problems or situations that could happen. The reason for why it went to 11% from 30% is because Hamas attacked Israel. Just think about this, right? Think about this. Not only was there a massive geopolitical event that could cause inflationary pressures through supply chain bottlenecks, through labor shortages. Israel is actually a crucial part to the American economy. People forget how much investment we have in Israel, how much defense spending we have. Like, Israel actually matters a lot. That's why they're a big ally. And obviously for oil prices. Now, oil is down today. We're seeing oil down 0.95%, which is phenomenal. We need oil to stay below 100 and particularly below 90 for us to continue this equity rally momentum. But oil is down today. But the idea that the Fed would raise rates after a horrific terrorist attack happened in a region that is incredibly unstable, that could create a lot of volatility being exported all across the world. I mean, that would just be the dumbest. Like, it just doesn't make sense for Jerome Powell to do that. So notice there, the reason why we're likely not going to raise rates in the November meeting, why it's now almost confirmed, this 11% chance is really it's probably not going to happen. At least that seems like what the data is suggesting, is because of something bad happening. Something broke, right? Something actually broke. And so the idea that we lower rates in 2024, it might be because something breaks. Maybe unemployment goes too high, right? And so we need to lower rates to encourage businesses to borrow capital so that they can spend and, start businesses, hire more people. Maybe housing market crashes and we need to lower rates so that people can actually go get a mortgage, because 8% is absolutely insane for people to have a mortgage, right? Especially if you're a 27, 28-year-old trying to buy a house for, you get a 30-year fix. That's just ridiculous. Maybe car prices just get too high. Maybe the strikes. Right? There's so many different catalysts that could happen that could potentially break the economy, which is why we need to lower rates, which is actually not good for stocks. At least in the short term, the lowering of the rates will eventually be bullish. But in the short term, there's going to be pain because there's something happening in the underlying economy that's causing pain. And, the market might actually suffer because of that. So as a result of that, it is really nice to see the equity markets rallying. From my understanding, this is what I want to tell everybody here in terms of the research I've done. Every analyst and every sort of report I've read over the past week is calling for a end of year rally and then 2024 for there to be a massive sell-off. Now, that's what they were saying back in 2022, and the reverse happened. 2022, there was not an end of year rally. We bottomed back in October. I remember Open Door was at 94 cents in December 2022. And then 2023, we had the rally. So last year they were saying end of year rally and then sell off. It didn't happen. The inverse happened. 2024, they're saying end of year rally and sell off. 2024 is looking more likely, or 2023 end of year rally is looking way more likely. 2024, maybe there's a sell off, maybe there's not. Now, we heard from JP Morgan yesterday that 2024 is going to be great, and they gave us a ton of reasons why 2024 is going to be great. So there's obviously a lot of different perspectives to this, but it is something to think about in the context of why the market, if you're just joining in, PPI data came in much hotter than expected, why the market just doesn't care. Why the market's like, you know what? We're not going to entertain this as some horrific event for the market because eventually inflation will come down enough, and that's why equities can go down. So it's going to be really interesting over the next couple months to kind of see where this goes from there. The CPI comes out tomorrow, and as Ty Gordon says, maybe car prices got too high. It's going to be, remember, the used car price index is 7 to 8% of the entire CPI. The only reason that might be higher is because if these auto strikes reduce supply on the market for regular cars, then people went to used cars. That increased demand. Less supply means prices go higher. So you could imagine that increases, that ticks up CPI. CPI is going to be really interesting tomorrow. Again, we'll be live at 8:20, 10 minutes before it's game time, because that report, even though it's probably less important than PPI, quite frankly, the market thinks of it as a lot more important. And on a headline number, it definitely will have impact. Now, tomorrow, if CPI comes out and the market doesn't care, that's going to be an interesting market. If the market actually is like, CPI is a little hotter than expected. We're expecting 3.6. We were at 3.7 last month. If we get 3.5, I think it's great. If we get 3.6, I think it's great. If we get 3.7, 3.8, definitely going to be hotter than expected. And if the market shrugs it off, that will be very interesting, because then the market's just being like, all right, we're in full-on rally mode. We don't really care about any of this stuff. Diane says, as a 28-year-old single girl, I had a 9.9% mortgage back in the late 90s. I'm happy you bring that up because I know a lot of the older people are like, this is kind of ridiculous, complaining about, 7% mortgage rates, 8% mortgage rates. The problem is since 2009, we basically had near 0% interest rates, and it was a decade plus of quantitative easing. And so I don't know, right? But the next 10, 20 years are going to go down in history of like, how did the economy recover after having a great financial crisis in 2008, therefore having a decade plus of quantitative easing, stimulus, low interest rates, and then having a global pandemic that printed 50% of the money supply in the past 7 years. It's for us to recover from this in a soft landing or whatever it may be, it's just going to be incredible. And so we are going to see kind of how the market reacts over the next couple months. Jeff says I had 11%. Damn, bro. Y'all had some high interest. Now, granted, inflation was down in the 1990s compared to where it is right now. So the purchasing power of capital, I assume, meant more. I remember, look, my dad owned a liquor store for a good 15 years. And I remember the Hershey bars, right? Chocolate bars, Kit Kats, Snickers, Twix. They cost 50 cents. Dude, they're $1.70 now. Like when he was selling them, a bag of chips cost 25 cents. Now a bag of chips is like $1. Like it's like a soda can was 50 cents. Now a soda can is $1.25. So I grew up with like sort of consumer groceries my whole life because I was in that store every day for like 8 years. And so I knew the prices of everything. I was ringing people up at the customer, at the register. I knew everything. So when I see prices today, when I go to like a local Wawa or something, I'm just like, wow, this is not what we used to charge for this stuff. Faisal, you're just coming in. A PPI did come out. So for those who are new, let me do one quick rundown of PPI one more time, and then we'll move on to the Exxon news. So this is for the people that are just joining in. Here is what we saw on PPI. Year over year, actual 2.2 versus 1.6 estimated. So it was a little bit higher. Month over month, actual 0.5 versus 0.3 estimated. Higher than expectations, but lower than what we had last month at 0.7. So we did go lower, which is, I think, the metric that's saving the market right now, even though we were higher than expected, lower than what we came in last month in August. Core PPI year over year, actual 2.7 versus 2.3, higher than expected. And core PPI month over month, actual 0.3 versus 0.2, higher than expected. Not the hottest report, but definitely a hot report, right? If it was a girl, it would be like on hotness, it would be like an 8 out of 10 versus a 10 out of 10. So she's pretty hot, but like she's not that hot. And so the market's like, all right, we're not going to sell off that dramatically, but we're going to sell off a little bit. But now you see companies like Robinhood recovering 10-14 in the pre-markets right now. Yeah, see, Jeff, your house was 140,000. So now the average price of a house is, I think, 380 or 430. I think that's the last number I saw on Zillow. So 140,000 for the house is just like a pipe dream in today's economy. That's just not happening. Mark, I'm not going to read your question out loud, but just know we did sell these. And I asked my uncle who helped out in the store what they were, and he did refuse to answer my question. But I tried asking him, yo, what are those? And I was like 8 years old. He was like, don't worry about it. Because there was an attractive woman on the cover of those things. And I was like, hey, what is that? All right, Exxon Mobil dishing out $60 billion to buy Pioneer National. Let's get some coverage on why this is happening.
Breaking news this morning. It is now official. A deal that has been speculated about for months. Exxon Mobil is buying Pioneer Natural Resources. This is going to be an all-stock transaction. The offering price, this is a $59.5 billion deal, which would be the largest purchase for ExxonMobil this century. This is the biggest purchase they've had since going back to the purchase of Mobil for about $75 billion back in 1998. It looks like this is a deal where, in terms of the deal, Pioneer shareholders are going to be receiving 3.3234 shares of ExxonMobil for every Pioneer share. Again, an all-stock transaction, and they are valuing this based on the closing prices as of last week on Thursday, the 6th of October. That's because while rumors for this deal have been circulating around for months, going back to March and April, things picked up again last Friday when there were reports once again that this deal could be happening. And at that time, you did see the stock pick up, shares of Pioneer Natural Resources. Taking a look right now at what they say on this, they say that they think this deal will sharply help things, they think, from a U.S. energy security process. They're talking about Exxon bringing their own technologies to bear on this with Pioneer Natural Resources, which is by far the largest producer in the Permian Basin. Together, the two of them are going to be even larger. Pioneer was already number one in this basin. ExxonMobil was number 5. So this is a big catapult for Exxon to really boost their Permian Basin. They've got 850,000.
So Exxon is down 1% on this. This is usually what happens when an acquisition takes place in the public markets. The company buying is down because they're dishing out a crap ton of money, whereas the company that's getting bought out obviously gets the premium. So this is interesting. I'm going to PXD on my Robinhood real quick, because the premium they're getting is they're getting a 10% premium, it looks like, which is not that much. I might be wrong on this. Or are they getting so the market cap right now in Robinhood is 55 billion. If Exxon's buying them for 60 billion, it looks like they're paying 10 billion over the current market cap. If the market cap was at 50. So, I mean, obviously 60 billion is very expensive, all stock merger. So it makes sense that, they're spending a lot of money on this. But for Pioneer shareholders, if you were holding for the long time, I'm sure it's good. But if you just got in because you got some insider information about this or something, I don't know if it was the best. Look, 5 years ago, the stock was so if you bought in 2020, the stock was at 82. They're getting bought out right now, I think, at 250. So that's a good return. But if you got in at the beginning of the year, the return's not that amazing unless you got in the dip around March 2023 when the Silicon Valley Bank collapsed. So not sure how amazing it is for shareholders in terms of the return, but obviously, if you've been holding Pioneer for a long time, very good for Exxon. I don't own Exxon. I don't own Shell or BP or any of those companies. If you do, you probably own them for the dividends. So this is good for you. It's continuing to allow them to expand their operations in regards to producing oil and natural gas. And it just shows that renewables and solar are not taking over the world yet. It's going to be a while before we are done with oil and gas. So we're likely going to be seeing more acquisitions like that. The other reason why that acquisition is good is because the fact that companies are willing to IPO, they're willing to acquire, they're willing to put out liquidity. It just means there's more economic movement in the markets, which is important, right? Because you need that stuff happening for a healthy economy. This is the type of stuff that should be happening. If you remember 2021, we had a new company going public every other day, right? And that's good. That means there's liquidity, but sometimes when it gets too much liquidity, then it's obviously not as good, or could be signs of a bubble in the broader scheme. I want to discuss Palantir for a second, have a little conversation on Palantir. So I was talking to a fund manager yesterday on Palantir. This is someone who manages about 30 million bucks in the great state of Texas. And here's what he said to me, okay? He said, look, valuation is tough for this type of company. It is benefiting from a lot of macro factors, and institutions don't own it yet. So 60% retail, 30% institutional when it comes to Palantir. It could be classically overvalued, but growth rate is likely accelerating, recently became profitable, and could be added to the S&P 500, which we're likely going to see in November after their earnings results when they're GAAP profitable for the fourth quarter in a row. Seems like they are actually benefiting from the AI trend. Lots of others are claiming to benefit from AI, but cannot say the U.S. Army is employing them for AI. So this $250 million contract we got yesterday, which propelled Palantir to get pretty high. Also, if you guys saw Palantir yesterday in terms of what it was doing after hours, it was really interesting. I mean, let me just show you their chart real quick. This thing was weird last night. Can I still see the chart? Actually, let me just, I have someone sent me a picture of it. I'll just pull up that picture. But while I'm pulling up that picture, what essentially this guy is saying, I think he has like a couple 100,000 shares of Palantir. He bought in at $7, $8. The reason I'm messaging him is because he bought in because of my videos. So he saw some videos. He was like, all right, you know what? I'm going to buy this thing. The interesting thing here is that Palantir is actually benefiting from some of this operationalization of AI. And this is his thoughts are familiar to what Mariana was saying in the Bank of America report, which is that when she's talking to customers, there's only two verticals that AI is actually leading to outsized returns. Market open in about 15 minutes, healthcare and defense. And so there's not that many companies that are receiving $250 million from the Army to operationalize AI in the defense sector. But Palantir is, right? And so when you've got things like that happening, it's really interesting because as a fund manager, as a guy who manages a lot of money, he's admitting, all right, it's probably overvalued. Probably a little higher than expected. Probably shouldn't be as high as what it is. But if the growth is coming back, AIP customer count, which he also agreed is the sort of A-star metric that all investors should look to, not revenue growth, but rather the customer count, because the revenue growth will come as a result of the customer count. If that can continue growing 50% month over month, even to 30% month over month, that's amazing. S&P 500 catalyst is going to happen as their gap profitable. Fund managers are just going to have to buy the stock. This could very well be the case of one of those stocks that's classically overvalued, but a lot of growth is coming in the next year. And then on top of that, they're not the company that's saying AI is going to benefit us. They're actually getting contracts because AI is benefiting us. And I think that's the biggest point that I heard yesterday. Palantir, as you can see right here, this is after hours. This is around 9 p.m. last night. This is the spike to $18.40, and then it came right back down to $17.80. This big green candle right up to the top. So we spiked from 17.60 or whatever to 18.40, and then 2 minutes later we came right back down. Usually when that happens, there's some stuff going on in the dark pool. There's some stuff going on in options chains. There's some funds trying to have a little fun, with different stocks. And so we'll see today as the market opens. Currently right now in the pre-markets, Palantir 1786. We'll see if that has any significance in correlation to what ends up going on a little bit later. So that is kind of the update on Palantir. Again, fund managers seem to be bullish on it. He could be selling, but it seems like he's not selling because when you're getting $250 million from the army for AI, it's like, hey, maybe let's see what happens. Maybe let's keep this train going and keep the party on. Okay. Macro. Let's do a little bit more macro news, and we'll get into the market open. We got 13 minutes until the market opens. Let's check on some equities and see how they're doing. If you came into Finance Junkies last night, we talked about not CNBC. We talked about TFC, and on TFC, we did a pretty good, 20-minute segment on why it was running. Again, the core reason for TFC, one of the largest regionals in the United States of America running, is selling off their insurance business. If you get to their book value, which is their assets minus their liabilities, the company is valued at $42 a share. Book value. It's trading at $29.38. At one point, a couple days ago, it was at $26.85. Substantially undervalued from its book value. However, there is a reason why it's undervalued from its book value, and it's because they have a ton of losses on their portfolio. We actually looked up the numbers last night. $14 billion of losses TFC is holding on, I think, $500 billion of deposits, which is not good, but they are paper losses. So as soon as the interest rates come down, those losses are not going to be real losses anymore. So the reason they sold their insurance business is basically to free up some liquidity so they don't have to sell those loans at a material loss, because those loans don't have to be a material loss. If you just give it maybe a year, maybe 2 years, a lot of those loans will start reaping ROI for them, because, when you mark to market, when interest rates go lower, then there's going to be a positive return there. Essentially, their net interest income margins are going to increase, all that stuff. But you got to give it time. Steve, I forgot his last name, but the guy who predicted The Big Short, Steve Eilsman or something. I'm totally forgetting his last name. Someone put in the chat. I know you guys know him. He was the guy in The Big Short. He went on CNBC yesterday and said banks are uninvestable. And his common argument for banks being uninvestable was just interest rates, right? He didn't really give any interesting arguments other than the fact that interest rates are high and that banks may suffer from that. And look, it's not a bad argument. It's not a bad reason per se. But 5 months ago, he was saying banks are actually fine. So you got to take some of these things with a grain of salt, because a company like TFC, if they have Eisman, right? Eastman, E-I-S-I-M-A-N, Steve Eastman, I think that's how you say it, or it might be Eisman. If you have some optionality in terms of what you can do, which TFC does in terms of their insurance business, then, you can maneuver the things. Obviously, JP Morgan, no matter how many losses they have in their portfolio, they have $3.8 trillion in assets, right? So they don't really care. They'll wait it out. They have plenty of time. Bank of America has $3 trillion of assets. These guys will be fine, even if in the short term their stocks get hit. If you buy banks, your bull case is that interest rates will come down. In the long term, these banks will go back to book value, especially companies like TFC that have obviously been massively sold off. Bank of America right now, currently at $27.20, actually up from $25.86. PayPal, $57.97, running a little bit in the pre-markets, 0.43%. Enphase, look at that. Enphase, $128, inching closer to $130. Enphase was up 5% yesterday. Now it's up 2% in the pre-markets. I really want Enphase to do well. I want Enphase. I don't want Enphase to get stuck in that $90 range, $100 range. I want Enphase because, it's a phenomenal company. They're doing well. I would argue they're overvalued by any sense of the imagination, especially after the recent decline. I think Enphase should do well. They should be fine. I know a lot of people who are fans of Enphase. I have a couple of shares of Enphase. Enphase should be fine. Especially given the fact that if inflation is coming down, nicely by Q1 2024, we might get the rate cut. And if we get that rate cut, all expectations have to be revised in terms of how solar is financed, which means guidance may be revised and overall Enphase may end up doing really well. And this may be a dip of a lifetime. However, remember, if you like Enphase, you've got to keep up with the interest rate story. If that interest rate story is not coming down anytime soon, Enphase is not going to be in a good position. Matt, literally right after I sold a bit. Yeah, we had a guy on Finance Junkies come on yesterday at the end of the show. He called in and he said he sold his entire portfolio except Palantir. Smart move. When he saw the Israel event happen, when he saw the Hamas terrorist attack. And his logic was he thought it was a black swan event that the entire market would sell off on. Now, to his credit, he's ex-military, 20 years, right? So he probably has some personal experience that influences his decision-making. Obviously, it's personal investing for a reason, right? We all have different experiences. But the market's taken off. The market's going crazy. The market's going up. And we still have a situation in Gaza and a ground offensive going on with Israel that's not really resolved itself. So it just goes to show, trying to time this thing, it's not easy. Like, the guy had a pretty logical case for why the market should go to crap after this Israel terrorist attack. Even I thought Monday would be a bad day for the markets. And markets are fine. Markets took in that data and they're doing well. So it's just tough to try to time a lot of stuff. But Matt, I'm assuming you took that money and put it into PayPal. So eventually you'll get those returns. Let's get an update on the Magnificent Seven. We got the market open in just a little bit. So here's Amy Wu. We've heard of her before. She covers a lot of the Canadian markets and the options market. Her argument is that if the big seven don't sell off, then the market's going to continue to do really well over the next year.
What's your WEX word of the day?
So my WEX word of the day is a little bit of the opposite of that. It's tail risk.
Really?
And the reason I say that is, look, yes, obviously the geopolitical events in the last few days have really changed the tail possibilities that are in the market. But what I find very interesting is you're not seeing it reflected in volatility at all, Frank. When we first saw Russia-Ukraine happen, you actually saw VIX spike to 35. We actually haven't seen anything of the sort so far.
That's an interesting point. Russia-Ukraine happened February 2022. The VIX, the volatility index, spikes to 35. VIX hasn't spiked to that level given these terrorist attacks.
VIX has stayed subdued and below 20.
Amy Wu being a bit of a contrarian this morning. All right. So I do want to talk to you about some action in the market we've seen. We've seen small caps really rally over the last couple of days. As a matter of fact, over the last week, they're the best performer out of all the indices. What do you make of that? Is that simply just the easing of the bond yield pressure?
Look, I think that has a lot to do with it. I do think growth versus value, small cap versus large cap, these kind of trades are ones that investors have been hoping works for a long time. It's something our own strategist has called for from a valuation perspective. I think it's a little bit too early to tell right now. We've seen these kind of go ahead and then lose momentum. So we'll have to see if that continues now. And I do think when you look at it, it's also just a question at this point of valuation.
All right. So, you know, this time during the day, we really like to focus on moves looking ahead. So with the idea that bond yields are easing right now, what picks are you looking at right now that you think are more investable in light of lower bond yields?
Yeah, you know what's interesting is conversations we've had with clients since last week into today, was just this question of, have we really seen a bottom in these rate sensitive sectors? You saw these massive sell-offs last week in your TLT, in your utilities, in a lot of consumer areas that would be hit hard as rates go higher. And so the question of, and frankly, the geopolitics bakes into this, right? Because some questions of whether or not the rate easing will happen more because of these geopolitical risks, I do think people are starting to ask, look, have we seen a bottom? And if that is the case, are those same rate sensitive sectors I mentioned before the ones that we can finally have some upside in? And people are starting to look at that.
Yeah.
And a lot of that, again, are those small caps and mid caps that are incredibly sensitive. The small caps more to higher interest rates. So if we are seeing a bottom in those interest rates, or seeing a top to the amount of times those rates will be increased, we might be seeing a bottom in those equities that are very sensitive to those interest rates. Okay, we got 5 minutes into the market open. Want to address a couple of quick things. First of all, headline in the United States of America: the White House, Joe Biden, is cracking down on new efforts to get rid of tens of billions in junk fees. Joe Biden did address the Israel-Hamas attacks yesterday, And, to his credit, he was pretty objective in terms of saying that, these are terrorist attacks, these are bad, and we condemn them. There's a lot of internal chatter in the United States. Obviously, on Monday, I said there are both sides to this story. One side are terrorist attacks, and then another side, whether you like it or you not, is a perceived perception that these terrorists are actually freedom fighters. That is not my belief, but that is the belief from a lot of people who are protesting in a city I'm actually going to today. I will be in the Big Apple. I'll be in New York City. I got some work to do there today. And in New York City, just 40 minutes away from me, there were people saying that what these Hamas terrorists were doing was actually fighting for their freedom. So in a world in which not only is the world, the Middle East kind of conflicted over this topic, but in America itself, there is not unilateral condemnation over these terrorist attacks. It was really important for Biden to come out and say, hey, this is not good. This is a bad thing. And we condemn this stuff. He seemed pretty emotional about it. So I'll give him some credit there. And so that was, really good for in terms of just a lot of people and the stock market kind of recognizing what Biden's stance on it is and what is going to be Israel's stance on it. In addition to that, he announced an effort to crack down on billions of junk fees. Now, these junk fees, what I'm seeing is basically big banks charging massive fees or trapping people in customer service loops. Wells Fargo, Bank of America, region banks have consistently done this with things like overdraft fees, sign-up fees, et cetera, et cetera. I don't know how successful this policy will be in terms of getting rid of these junk fees, because I've had Bank of America for a long time and I've had to deal with billions of junk fees. I mean, I haven't paid billions, but you know what I mean? I've paid tons of junk fees over the past 8 years. However, I wanted to bring this up because this is actually a very big bull case for SoFi. SoFi, to my understanding, has zero of these junk fees because they're a digital bank. They actually care about the customer. They don't need to make their money on a $35 overdraft fee because you forgot that one account didn't have that much money in it because all your money's in the stock market. Bro, I literally feel poor. Yesterday, I went to the bank just to take out $100 because I like paying for gas and cash. So I needed $100. I don't have any money in my bank account. I had $200 in my, I truly feel poor every time I go to pay for something because all of my money is in the markets or it's collecting 5% in Robinhood. And I think that's actually a good way to kind of allocate my capital, to just not have it in my bank accounts. But I never feel like I have any money. So sometimes, yeah, there is a little bit of an overdraft because I don't keep that much money in my Bank of America. And sometimes I spend and I'm down $2. And then they charge you $35 even though you replenish your account in 50 minutes. It's just insane, right? SoFi has never done that. And I think that's why SoFi has gotten so much customer loyalty. So the fact that Biden has to literally create legislation to stop Bank of America and Wells Fargo from and JP Morgan from these ridiculous fees it just goes to show you how much power the US government doesn't have over private institutions like banks. Whereas SoFi unilaterally decided themselves, hey, let's just not do this. And that's why I think they're getting a little bit more customer love and definitely getting a lot more deposits leaving the bigger banks into their bank. So I think that makes a lot of sense in the context of what SoFi is doing in their customer acquisition strategy. Chase just started a $6 monthly fee. Wow. See, that's ridiculous. Chase has 3.8 trillion in assets, bro. They don't need your $6. That's what, 6 times 12, $72. Do they really need $72 from you when they're making it's just annoying, but they can do it because they're the biggest bank and you're not going to leave, right? And that's the problem when it comes to some of these bigger banks. All right, we got about 30 seconds until the market open. This is going to be really interesting. We got Truist is up nicely, JP Morgan's up, Bank of America's up, SoFi's up, Tesla's up, Enphase is up, Tesla up 0.96% in the pre-markets. Robinhood doing pretty amazing right now in the pre-markets, up 10.07. It was at 10.14 at one point. This is going to be a very interesting market with the PPI data coming out hotter than expected. So we are going to see how the market chooses to react to this one and if the momentum and the party continues to happen. All right, here we go. It is 9:30 a.m. Thank you all for being here with me. Another day. The stock market is now open. Wake your asses up. Here we go. Time to get into it. Palantir, $17.83, up 0.22%. Again, yesterday, Palantir spiked to $18.40 just before after hours closed and then went back down to $17.80. Right now, Palantir at $17.88, up 0.40%. Robinhood, 0.43% up at $10.08. Not bad for Robinhood. SoFi breaking through $8.50, up 1.79%. Not bad at all. SoFi was at $7.30 last week. So if you bought the dip on SoFi, pretty nice gains from last week. SoFi rallying, continuing from yesterday, being up about 4%. Bank of America's up at 27.19. JP Morgan up at 146.84. Truist 29.47. Again, we talked about Truist last night. Truist continuing to get some momentum to the upside on Truist at $27 or $29.47. Again, selling their insurance business is giving the market a little bit more comfort in what they're going to be able to do. Shopify 55. Disney, look at that, 85.68. Not bad at all. That activist investor that came in, I didn't still do as much research as I need to do on who is the activist investor and what activism they're trying to do. But I do think the stake is like $2.3 billion that they just picked up in shares. And so Disney might have some new management or some new direction coming over the next couple of months. NVIDIA, 462, not bad at all. Look at that. NVIDIA was at 412 last week, now at 462. Tesla inching towards $270. Wow. Either this is setting up to be a bull trap going to earnings, because I think unilaterally the Tesla community has acknowledged earnings is just not going to be that good, or the market doesn't care. They're looking past all the short-term delivery, production, automotive margin issues. They're seeing what Elon's posting about FSD on Twitter, and they're like, you know what? This is a company to bet on in a world in which interest rates are going to come down, and it's one of the only high-growth tech companies that's actually growing at 40+% year over year. So Tesla, 267 up 1.25% on the day. Remember, Tesla had bad news over the past couple of weeks in regards to price cuts and delivery misses. Still, the market does not care and continuing to do well. Enphase, look at that. 40 cents away from 130s. We haven't seen 130s on Enphase in a long time. We haven't seen it in a while. Enphase right now, 129.34, not bad at all. PayPal also rallying 1.6% on the day, $58.68 we're seeing on PayPal. ARM at 55.75, not bad at all for ARM. Google, 140. You got into the 140s. Yesterday, we did not get to the 140s on Google. It took a while to get to that one. I think 138 was the high. 140, that is a new 52-week high for Google. Not bad at all. Oh, Palantir spiked. There you go. Palantir spiked. Look at that. Look at that. 1812, up 1.8% as well. This is an incredible market we're seeing right now. Look at that. Palantir, 1814. It was just at 1780, 40 cents up. Look, I'm losing my voice. Fun fact, on Monday when Palantir ran from like 1610 to 1750 or whatever, and I was on for like 2 hours, I went downstairs. My mom was home because of Columbus Day, and I literally couldn't talk. She like asked me a question, and like my voice couldn't talk. She was like, "Did you talk that much?" I was like, "Yeah, Palantir went up like 5%." I had to like, it was definitely lost my voice there. SoFi at 861, another 3% day. Yesterday, SoFi was up 3%. Again, SoFi is up 3%. Coinbase, Bitcoin people, it's up at $80. Where's Bitcoin? I think Bitcoin declined last night. Bitcoin 27,120. Okay, so Bitcoin's down pretty badly. It was at, it was closer to 28.5 at one point, I think last week, now at 27.1. But Coinbase is up. That's actually weird. Coinbase, you wouldn't imagine to be doing well if Bitcoin's up, but Coinbase is doing well. NASDAQ, 13,651. Not bad at all for the NASDAQ. ARK Innovation at $40. DNA, Ginkgo Bioworks, $1.83. Amazon touching 130 as well. S&P 500, 436. Not bad. Remember, S&P was at 419 last week. Now touching higher. Snowflake at 164. Google at 139. What else do we have here? Meta, look at that. 324. Goodness gracious. Meta was at 284 2 weeks ago. Wow. 324 on Meta. My biggest regret is not buying Meta. You guys want to know, for the people who don't know, I bought Meta at $325 a share. I bought 10 shares of them in February of 2022. That's how, and then so obviously it collapsed. I sold out of it. I said, screw it. I bought Palantir at 12, and I only had 10 shares, right? It wasn't too crazy. And then Meta went to $88. So I thought I was a genius. I was like, oh, I got out of Meta, even though I bought it at 300. It went to $88. That was a classic fallacy of not realizing, you idiot. You bought it at 325 because honestly, it's a phenomenal company. Cash flow is amazing. Free cash, like just margins incredible, right? It's growing, 3 billion users. It went to 88. You should have been buying it, right? And so one of my biggest regrets over the past year is that I did not pick up Meta at 88, because I honestly believe in Meta. Like, I really believe in the company. I love Zucks. I don't care about the metaverse too much, but their advertising business is just phenomenal. But I didn't buy it. And 88, I don't care what type of investor you are. If you care about value, $88 was value. Did not pick it up. Lesson learned. So hopefully we'll be better in the future. But Meta doing phenomenally well at $325. Square even breaking out a little bit at $47.32. Square was stuck at that $43 range. So we're now seeing Square at 47. Myra says, Amit, you know that's not your only regret. Quit lying. No, I don't have any regrets about girls, any regrets about life. The only regret I have is I didn't buy Meta at 88. That is the obviously, no, I have some other regrets in life, but that is a pretty big regret, Bo. Being able to say I bought Meta at 88, it's like a badge of honor at this point. Especially because I bought it at 300. So why the fuck was I not, like, am I like that's just so dumb. But and I had cash. I had some free. I remember I think I had like 15 grand this October 2022 when it crashed, because I was with Vitaly on the live stream. I remember this whole thing happening. Didn't buy it. That was the issue. But nonetheless, you live and learn, and you got to move on. Apple at 178.62. Apple doing well. Roblox breaking out of that 20s jail that it was in, now at $31. Airbnb giving up its 8% gains from the S&P 500 inclusion, now at 132. Airbnb, I never liked this company, quite frankly. I always thought it made the VCs rich. Didn't really make shareholders rich. $85 billion market cap. I think they do $4 billion a year in revenue. I was just never a fan of Airbnb, ever. Like, I never thought, oh man, I want to hold Airbnb stock. I also didn't like how they did the IPO process. I think the banks got rich and shareholders kind of got screwed. So, Airbnb is fine. Phenomenal company. Brian Chesky, amazing CEO, but never really enjoyed the stock too much. Even C3 AI is up 1% today at $27. On this, Israel Hamas news, you would imagine C3 AI, if it's playing any role in defense, because they boast about their government clients, they would go up a little bit. But no, right? We don't really see that much momentum there. Spotify 158, Paramount Global 1250, Zscaler 174. I know some people are in that stock. Palantir at 1826, up 2.5% on the day. Not bad at all. Google, I just got the notification, 52-week high. You got Arnie, who loves Airbnb. Ezra's Palantir is close to breaking out. We got SoFi, Enphase at over 130. Wow, Enphase at over 130. Goodness, Palantir now at 1830. Enphase 130.68. This is amazing. So I'm looking at my portfolio. I'm currently up $5,319. That is total on my portfolio. What's up the most? Oh, these TFC calls are fine. Yeah, these TFC calls. That's what's doing it. They're up about 5% on the day. TFC now at 29.67. SoFi is also doing pretty well. Yep, the SoFi calls. I sold off a bit of the SoFi calls last week to buy some Google. And then I freed up some more cash, and I bought a crap ton of more of those SoFi calls on Monday when we had, or not Monday, on, was it Monday? No, it was last Friday. And so it was a pretty good buy because I got back in. I didn't sell a lot to buy Google, but I sold enough where I was like, I want to get some more money into this. And so SoFi is doing well. SoFi is doing well. Again, all of this could come crashing down if we have some more events on the macro that aren't that nice. But even with, remember, for those that are joining, we got PPI data today. That PPI data came in hotter than expected, even though it came in lower than last month, hotter than expected on the month over month. And then core, year over year, the other metrics, they were all a miss. They were all hotter than expected. There was only one metric that came in better than last month, but it was still hotter than what was expected. So it's not the best CPI report. It really wasn't. Enphase now at 131, or sorry, PPI, not CPI. But the market ate it up and said the market is fine. And so the market is going to... the market said, you know what, we're just going to keep going forward from that. We don't really care. Moments like this, do you scoop a little profit? Martin, that's a great question. Let's put it in the chat. Who's taking some profits today? Or if you've taken any profits over the past couple of days, put it in the chat. Let's crowdsource an answer to that question. Robin at 1014 and Palantir at 1829. My answer is yeah. Like if you, I'm starting to think that people should have a long-term portfolio and then a portfolio that they play with, because sometimes you just want to sell a little, buy a little, and you play with that portfolio, and that's totally fine. And then there's some stocks you shouldn't touch. So if you have an average of 7 on Palantir, just like the guy who came on Finance Junkies yesterday, I would not sell anything, because look, at 18, it seems very tempting. But if you know the company, like I know the company, like this is a big company one day, and you hold and you make real generational wealth. Now, if you have some 10,000 you're playing with and you have an average of like 15, yeah, take some profits. You're up $3 a share. Buy some, sell it at 18. So I don't know. I think for the long-term companies, there's no point to take the profits, because that's just not a way to get generational returns, like real wealth, even if you have a $7 average at Palantir at 18. You would have to be betting at selling at 18 that Palantir would go back to 7, right? That's just not going to happen. So from that perspective, I don't think that it would be, I don't think it makes much sense. But again, it's up to you. It's determined. Like I sold some SoFi the other day because I needed some profits, right? I wanted to allocate into Google. So I sold SoFi and I bought some Google. So it's based on what you want to do. Also, I saw SoFi going down pretty aggressively, and that's why I sold some, because I didn't want, it was it was still up like 20% above what I paid for it. So I was like, let me take a little bit of profits here and let me allocate it towards some more undervalued companies I think that are going to explode in Q3, like Google. And that's the play I made. But then when I freed up some cash 2 days ago, I just put that right back into SoFi because SoFi was still undervalued. And, you know, I believe in SoFi. I could have been wrong on that, but I believe SoFi was going to be fine. So, yeah, I think it's just a question of like, if you want to take some profits, but you don't have to sell entire positions. There's no point to do that. Father Links, thank you for the $5 CHF super chat. I don't know what denomination CHF is, but thank you for that. I appreciate it. I watch your channel a lot. Keep doing you, man. Much love from CH Palantir 2030. I love it. Thank you so much, man. I appreciate it so much. Thank you for joining. And yes, Palantir 2030. That is the goal, because in 2030, if this sucker's at 150, if AI is at a different level, if the government like quite literally relies on Palantir, not just the U.S. government, every NATO government, this company will be worth more than $18 a share. And so it's going to be really exciting to see that journey over the next 10 years. And we'll see what happens. I want to buy more SoFi, but I hate buying on green days. I agree. Thank you, Matt, for this comment. I don't think anyone should be buying on green days. I don't buy on green days. I had a bad habit of doing that a year ago. I used to be like, oh, the stock's going up, I should buy. That is the dumbest thing to do. And I'm not the smartest investor, but that is the dumbest thing to do. You don't buy on green days, because green days will inevitably become red days, and you want to buy on the red days. So when they go to become green days, that you have some upside momentum. And when the green days turn inevitably red because you bought on the red days, you're not in the red on the red days because you bought on the red days, and now you're green. I should literally become a rapper. I don't know how I do this, but anyway, that's my point, right? So I personally would not, if you're doing anything today, it would be selling and taking some profits, not buying on some of these pretty aggressive days. Like my portfolio right now is up $6,964. I am not buying anything. I'm just looking at that money because tomorrow it could be right back down 6,000, right? So like you gotta get unemotional about the upswings, but you definitely don't need to be buying on a massively green day. Okay, let's look at some other stocks. Palantir at 18.26, Robinhood at 10.17. We're seeing a breakout in Robinhood. My thesis on Robinhood has been very consistent over the past couple months. Me and Arnie started really talking about Robinhood back in July. Look, the company's undervalued. It's just that simple. Market cap of $9 billion, $7 billion in cash. You're basically paying $2.5 billion for the brokerage that is now GAAP profitable. The bear case for Robinhood is, oh, what if there's a crash in the economy? If there's a crash in the economy, that means yields on bonds are going to go higher. And they're already at freaking 4.9% on the 10-year, right? Robinhood has $7 billion in cash. Imagine them just getting a cool 5% on $7 billion every single year. Not bad at all for Robinhood, which is what they've been doing in terms of their net interest income over the past 5 quarters. And then on top of that, let's say yields go down, which means interest rates come down, which means Robinhood can't get as much of a return on those interest rates, on those bond yields, those treasuries that they may invest in because the economy is doing well. Guess what? That means people are trading, which means the transaction revenues on Robinhood are going to go through the roof, because if people are actually buying stocks, Robinhood makes a crap ton of money. We saw what happened during the GameStop time, and we don't have to get to the GameStop frenzy type of era for Robinhood to still have massive explosions in transaction revenue, which means their assets under custodies go up. So to me, there's like, at this valuation, Robinhood's there's not really a bear case in my opinion. And if I'm wrong on Robinhood, I'm wrong about the entire company, but I don't see a true bear case for Robinhood at this valuation. At $20, yes, but at $8, $9, $10, I bought most of it when it was at $9.30. I don't see the bear case. SoFi 872, up 4.25% on the day. Yesterday it was up another 3%, so that is amazing. Truist, look at that, 29.82, up 2% on the day. We're inching towards that $30 on Truist. Let's see how the market continues to go with it. They have earnings in a week, but not bad on Truist. Shopify is up. Disney is up. Nvidia is up. Tesla, 267. PayPal is even up 2% on the day, $58.64. ARM at 55. Let's check on Instacart. We haven't seen Instacart in a while. Instacart at 26. Okay, so Instacart's still Instacart. Enphase at 130. Palantir at 18.27. Not bad at all, man. Not a bad market open at all. Benny says, hashtag ask Amit, what's the reason for the Enphase run? Do you think they're doing some buybacks? I forgot about the buybacks. That's a good point, Benny. Maybe they did the buybacks in the 116, 117 range, because we did see them like tick up to 118, 119 for a couple of days. But then they tanked to 112. So maybe the entire market was just like tired of them, even if they did their buybacks, or maybe they did the buybacks at 112, 113. Or maybe they're doing it right now. Honestly, I have no clue. I don't think this run is because of the buybacks. I think this is macro related. So I don't think it's because of buybacks. But in general, not bad at all in my opinion. I think the market is running because the market is choosing to run in the context of interest rates potentially going lower and inflation coming down. That's why the market's happy, and that's why we're seeing it. Retail also going up despite all negative pressures. Market is up because the dollar is getting beat down. That's another reason the dollar getting beat down. The market tends to do well. So that's a good point by Ty. Guy says, long term, this will be disastrous for the economy, but people won't hear the storm coming over the money raining down on them. Yeah, I mean, to talk about that a little bit, we talked about it in the beginning of the show. Remember, when interest rates come down, it's likely because something's breaking in the economy. So the consensus view I'm seeing from a lot of analysts is market's going to rally end of year 2023, and then 2024, we're going to get a crash. Now, remember, last year, they thought the same thing. Last year, they thought the market would rally. 2023 would get the crash. Instead, 2022, we hit a bottom in October. Market declined towards the end of October in December. Open Door was at like 94 cents. SoFi was at $4 or $5 in December. And then it rallied in 2023. So the inverse happened last year, which means, maybe if we're expecting a big 2024, the inverse could potentially happen again. I don't know, but most people are expecting end of year rally, and then 2024, something breaks in the economy, interest rates come down, and stock market has to come down because interest rates come down, or interest rates are coming down because something is breaking, which means the stock market in the short term is going to come down. Eventually it'll go up because interest rates are coming down. But still, if interest rates are coming down, that something is broken in the economy, which means the market will go down. Amit, can you do a video on technical analysis? My GF is really into astrology and I'm trying to connect with her more. That's funny. I would follow Jesse Dow on Twitter if you're really interested in technical analysis. I'm not the best at it. I know what RSI and RSI is. I understand MACDs a little bit, but I'm not the best at technical analysis. Let's check on Palantir. Speaking of technical analysis, on the 1-day RSI, we're at 56. So I know when we get to 70s, we're more at overbought. At 30s, we're oversold. Let's look at it on the monthly. So if we go down the monthly, the RSI is at 71. So on the monthly, people could argue Palantir is overvalued. And then let's look at it on the yearly. On the yearly, we had 68. So monthly and yearly are kind of on the same in terms of that RSI, whereas on the daily, it's at 56. Remember, none of these technicals matter if fundamentals take over, contracts take over, market sentiment takes over, retail takes over. All these technicals go to crap because at the end of the day, it's still a company and people have to buy it. And if people buy it, then they're buying it and you're going to see some momentum. Gabriel says, what do you think now is a fair value for Palantir and what is an overvalued price for Palantir? We've been talking about this on the podcast. 14 to 15, I think, is an incredibly fair value for Palantir. Now, a couple of months ago, I would say that's not a fair value. That would be overvalued because of their growth. However, they've shown a ton of growth in AIP in terms of customer count. They've shown the ability to land massive contracts. And this NHS deal, if we end up getting it, which I think we are, that is a win for the long-term trajectory of the company, which will create entire healthcare systems that are socialized in Europe buying Palantir software. That's going to happen if we get this NHS deal, which means you won't see it in the short-term price, but $15 is a steal in my opinion. If we get that deal. So I think 14 to 15 is fine. Look, is 17 to 18 a little bit overvalued? Maybe. Sure. Especially if on earnings, they kind of shit the bed and they show this 15% growth, which is just not good. Remember, the market's giving Palantir a premium on AI and on defense spending. That's why we got this premium over this 11% over the past 7 days. If earnings don't materialize to show any of that leading to actual upside in terms of revenue, I think it's going to be a very similar scenario to Q2 where we collapse back to $14. That is possible. The problem is the macro is doing really well. So if the macro is doing well, it might not be the easiest to see Palantir decline that well. To give the counter side to this, the last time Palantir was at 1840, this price we're seeing right now, we're hitting new intraday highs on Palantir, up 3% on the day. The S&P 500 was at 4,600. Right now, the S&P 500 is at 4,300, and Palantir is at the same price it was when it was at 4,600. So that is a bear case for why it's theoretically overvalued. But if the earnings can show some actual results and not just the $1 billion worth of buybacks, then maybe, the market continues to give them this premium. But I do think at this level, the market, they might take their profits. We'll have to see what happens. We will have to see what ends up happening. Arnie says we should be a few days away from the NHS. Yeah, we should know about the NHS very soon. Obviously, that Bloomberg article, I think, is pretty accurate. So we should know on it soon. Chris says, my hypothesis is Palantir had a buy at 14 for buybacks, helping them put the floor that is last quarter. I don't know. I disagree, Chris. I don't think Palantir bought back their shares. And you feel free to clip this when they announced that they bought back their shares in a month, but I don't think they did. I think when we saw that $14, $13 kind of swing, I think that was institutions we saw Kathy buy a couple million shares, right? She was like, this is ridiculous. I'm buying shares. And I think retail hopped in. I really don't think management bought in at 14. I could be wrong, but I think we would have seen a bigger kind of like print, and someone would have pointed out like, yo, there's 100,000 shares just got bought, or 1 million shares just got bought. So maybe I'm wrong, but I don't think Palantir bought back yet. But what else do we have? Bitcoin is down. Yeah, Bitcoin is down. I don't know why Bitcoin is down, but Coinbase is up even though Bitcoin's down. So I can't predict Bitcoin, bro. I don't know enough about it, but it randomly will be down, randomly will be up. It's like, all right, Bitcoin, whatever mood you're choosing to have. Interesting thing about Robinhood, the stock is up, but my calls are actually down today. And this is the thing about, volatility and stocks is like the underlying stock can do very well, but your price action on the options could potentially swing either way. So sometimes the stock has to outperform a little bit more for you to see the upside in terms of the options. The Robinhood calls, I think there's been a lot of interesting stuff going on in these spreads because it's been really like stuck in a certain range. And I think it's just waiting to break out, but it needs to see Robinhood get to that like $11 range to really decide it wants to break around. You need to understand the Greeks. That is also true. This is something I'm learning. I'm watching a lot more videos on YouTube, the thetas and the betas and the alphas and all that stuff. TJ, can we do a podcast on this stuff? Can we do a podcast on my channel where you literally break down every Greek, even though it's mythology, You guys like what I did there? Greek mythology. We need to do a podcast here. We'll do it live. Let's do it on like a Sunday morning. People have their coffee, some pancakes, and let's just discuss the Greeks. Let's give us a masterclass on why this is happening. Arnie can join too if Arnie knows about the Greeks. I think Arnie, you know about the Greeks because I don't know. I know about like Poseidon. I know about Sisyphus. I know about Athena. That's the goddess of love, right? I'm the god of love, so I understand that, but I don't understand the actual options Greeks. I gotta learn. I gotta learn more on that. Everyone's cringing at those jokes. They're like, oh my God. We tuned in for the market open. We got this wannabe Dave Chappelle. Okay, let's get into let's get a little bit more coverage on what's going on for the consumer and if there is going to be some short-term momentum going into the stock market. Let's play this and let's see what we got here.
Smart sheet.
Let's take a look right now at some key technical levels in the markets. We want to bring in Katie Stockton for that. Fairlead Strategies founder and managing partner, also a CNBC contributor. And Katie, all of a sudden, there are a lot of different moves. We've kind of switched momentum in different directions in different markets. Why don't we talk first about what's been happening with stocks? Because we've seen 3 days in a row of gains for the S&P, the Dow, the NASDAQ, and I think even the industrials too. So if you're watching some of these things, has this been enough of a shift that we need to think of things differently from a technical perspective?
Yeah, it certainly has. We saw a short-term momentum shift to the upside just in those past 3 days. And it's decisive enough to suggest that we'll see near-term upside follow through. Our short-term indicators all do now point higher, and that's across the board for the major indices, even for the small cap benchmarks, which have really been struggling, as you know. But with the bounce, we have also seen not only improved short-term momentum, but also improved breadth or participation. As an example of that, the percentage of stocks above their 50-day moving averages went from about 9% to now about 26%. And to the extent that that kind of breadth expansion can continue, I think that should add to the longevity of the relief rally. The S&P 500 faces initial resistance right around 4470, and secondary, much more important resistance around that 4600 level. And that, I think, is the real proof point for the market, that 4600. If we can see the S&P 500 surmount that, that would be a really big deal from a technical perspective. It would suggest that perhaps the cyclical uptrend, which we do believe to still be intact, is something more than that, something that is more of a resumption of the secular uptrend.
So that's one analyst saying that, look, 4450 is resistance on the S&P 500. And if we can get there, then there's going to be some, upside. If we can get past that, we're breaking through that resistance. If not, then that's likely going to be a floor for stocks. Remember, Tom Lee still thinks we have about 4,800 or 4,700 to go on the S&P towards the end of the year. If we get a 4,800 rally, it's going to be an amazing end of year. Like, it's going to be phenomenal. Now, if we get stuck at 4,450, that's not even as good as July when we were at 4,600. So, I mean, we'll see what ends up happening. But if we can break through that resistance, that'll be important. And again, I think a lot of it depends on if the Fed is going to lower interest rates. If you're just joining, the PPI came in hotter than expected, but not as hot as we thought. Therefore, market's doing well. And the percentage chance for the Fed to raise rates in the November meeting has declined from 30% to 11%. 30% to 11%. So as a result of that, the market is also probably feeling more likely that we are not going to get that interest rate raise on Halloween, October 31st. Okay, moving on to one more topic I wanted to cover, and then we'll be done for the day. SBF, a little bit more coverage on this guy because whether we like it or not, he actually does affect a little bit of the crypto markets in terms of the perception that's going on around FTX. Apparently, his girl, I forgot her name, Cassie or something like that. I forgot her name, but she's been ratting him out pretty aggressively. And in the trial that started over the past couple of days, Carolyn Ellison, she is the fifth witness for the prosecution. And basically she said that he put me up to all of this. So in the summer or fall of 2021, Bankman-Fried sent Ellison a potential bad scenario situation for FTX or Alameda, detailing a world in which crypto market was down and Alameda's investments plunged and the company becomes worthless. 10 percentile scenarios happen every day, said Ellison. So his girl was trying to tell him, like, look, we did some illegal stuff. The market hasn't crashed yet. Bitcoin is still at 40,000. If the market crashes, all of this goes underwater and the exchange collapses as well. And basically, Bankman-Fried ignored it. And he said, look, it doesn't matter. We'll just keep going from there. He was, in fact, thinking of taking out another $3 billion and investing them into early stage startups, likely crypto startups, which is why he wants to start a venture fund using Alameda loans. This is money from customer deposits to be able to invest in short-term crypto startups that probably were going to fail because crypto startups, tend to not do that well. And, use customer deposits on that perspective. So it goes to show that the guy has no standing in court. Customer deposits were being used. His girlfriend is continuously ratting him out. I mean, his girlfriend must have gotten the best plea deal of all time because the amount of info she's giving to the cops is just insane. And it looks like this guy is gonna be behind bars. I mean, I don't know what their defense is gonna be. They can't claim insanity. They can't claim that he was stupid. I mean, the guy graduated from MIT. He definitely wasn't an idiot, right? So they can't claim too much negligence. I don't know what the defense is going to be, but his girlfriend is not taking the fall, which is why you got to be very careful about some of these girls you get, in bed with, because she ratted him out like there was no tomorrow. And so that's the update on FTX. Could that be a reason for why Bitcoin is down at 27,100? My naive analysis is maybe, right? But in all reality, I think FTX is now far detached from what's going on with Bitcoin. The only thing that's happening is market perception, right? Because the more media coverage there is on how bad crypto exchanges were or how, bad crypto actors are, the more people are less enticing of Bitcoin or crypto related companies. However, I think this FTX coverage has been pretty expansive over the past couple of years now. So I don't know if it has any real direct correlation on the crypto markets. I would say technical analysis probably says Bitcoin is coming down, which is why Bitcoin is coming down, less about SBF. But if SBF doesn't get justice, that's definitely not going to be good for the crypto markets, or crypto in general. And so I would imagine he gets some level of justice, and that puts crypto people at ease to see what's going on from there. His defense is he's a super smart boy that messed up. Yeah, and that would be pretty sad if that's the way he gets out of it. FTX is being rebooted under new management. I did hear about that. I don't know if that's going to happen. Maybe that's going to happen, but I did see that was a rumor. Matt calls him a genius businessman, hinting a little bit of sarcasm in your voice. But yeah, I mean, look, we're seeing the downfall of one of the youngest billionaires of all time. Okay, final look at the markets, and then we'll end out for today. Palantir falling a little bit to 1802, so we're seeing a decline. It was at 1840, up 1.2% on the day, so still up, but it is down. Enphase is down at 127, down from 130. Bitcoin is down 2%. Robinhood falling a little bit at 1002, so people definitely took their profits on Robinhood. SoFi at 858. Bank of America down. Even Truist is down a little bit, 2950. So overall market, we're seeing a little bit of decline intraday from the peak S&P at 435, now down from 436, but still a very green market. Palantir still at $18, so not bad at all for the markets writ large. And we got Palantir. Here we go. Palantir. Oh, Palantir right now down at 1796. So this is obvious. We're going to see some profit taking. It's likely going to happen. Very green day. PPI was hot, but the market was able to absorb it. Markets are still up. probably definitely going to take a little bit of profits here and there. And if you take some profits, can't blame you. But overall, what it's looking like as the end of the year is not going to be too bad, given what we're seeing with inflation and given what we're seeing with yields being at 4.5%, coming down aggressively as well in the 10-year from 4.9%. Palantir at 1796 right now. All right. That is it for me. That's it. That is it. Amit, a last question. Would you still be a buyer in green market if your cost basis is higher than these prices? No. If my cost basis is higher than these prices, then I'm not buying. I'm only averaging up. Let me pull up the word of the day as well. If I really, really want to, right? Like I wouldn't average up on Palantir because the growth still isn't there yet in the context of the revenue side, right? So we got to see growth on the revenue side and the earnings for you to really average up. And look, if you have to pay $20 versus $18, that's not that big of a deal. But paying $18 because they got a defense contractor premium because of what's going on in Israel, where that has zero correlation in terms of actual contracts, that's one of those days where you sit back and you're like, this is why I own the stock. Not, oh my God, this is why I need to get into the stock. The market giving it a random premium that is correlated with the company but has nothing to do with revenue or contracts is a day you're like, all right, that's amazing. Not a day that, where you try to jump into it. So that's kind of what I think from there. No, if your cost basis is higher, meaning if my cost basis is 14 and Palantir is 13. Oh, so that would be averaging down. I see what you're saying. Okay. I got what you're saying. Okay, so that would be averaging down. I still would say no. The answer would still be no because it's a green day. And if you're going to average down, then you average down before you, like, as Arnie says, I'm missing real crashes, right? Yeah, that's when you average down. Even if you want to average down on a green day, again, you're chasing the green. The one thing I've learned, and hopefully this has some value, is that the red will come. Just like you're not going to be green at the stoplight at the traffic light. It's going to turn red at one point, right? Because there's other things that need to happen, especially if you're in an intersection. Other parties need to move. The stock market will be red once again. And I think sometimes we're in the green. We always think like, oh, it's just going to be green forever. It's like, it's been 3 days of green. It'll get red again. It'll happen. And you will have opportunities. You don't have to be greedy about it at all, especially if you're trying to average down. Average down on the days where, you need to average down. That's the one lesson I learned. Remember, in 2021, I was buying on green days. Like I was the retail noob that the people were selling to on the greenest of days. And I was buying. That was a mistake. I should not have been doing that. That resulted in a lot higher average prices for no reason. And so my lesson is I don't buy on green days at all. I just don't buy, and I wait till it comes down red. Word of the day, voracity.
Voracity.
Oh, look at this. This is perfect. Voracity refers to an immoderate eagerness or enthusiasm for something or to an intense desire to eat or consume something. Okay, so outside of the eating stuff, if you have voracity to buy stocks and you have too much eagerness to buy stocks on a green day, you're going to end up with some shitty prices for no reason when you can get those prices down to be red or get those prices down to be in a better price. As Arnie says, always be in a position where you're happy if red arrives, not sad because you bought on the green days and now it's red. And now you're looking at your stocks that are red on the red day, when in reality, you should have capital to deploy on the red days so that when it's green, it's really green. All right. That's it. Thank you all for joining. I appreciate it. This was awesome. One thing, that Palantir, so that thing we talked about yesterday, that one episode of Palantir, I think that will be coming out today. So I need people to watch that today. I'm starting one video a day, not multiple videos a day, and it'll be covering 4 to 5 different mini segments of Palantir in one jam-packed video. So I'm going to New York City, so it might come out today. It might come out tomorrow. We'll see. Honestly, it might have to come out tomorrow because I just might get too busy. But that thing will be starting, and I want to know your guys' thoughts on this. Need you guys to watch that one. Need you guys to tune in. Let me know what you guys think of the format, if you like it, if you hate it. And we will be officially doing Palantir Daily every single day. And we're going to try to get that into a video that becomes a routine. And that is the staple of the channel, that one video a day, no matter what the news is. All of that is in one place. And we have that going from there. So, yeah, that's it for me. I'm going to be in New York today. Got some business to do in New York. I'll be in the Big Apple. Follow me on Twitter. I'll probably tweet some pictures of it. Thank you all for being here. I appreciate it. And we'll see you guys later today on Finance Junkies. Good night, everybody. Thank you for being here.